Hello guys and welcome back to the channel. So in this video I came across a very old video of Tom Nash talking about Zoom, and the reason why it's so interesting is because since he made this video, he made the video on this day and you can see that the stock basically plummeted. And Tom Nash is a guy that I really like, I really look up to. He's one of those financial YouTubers who, actually does calculations when he recommends a stock. There is so many people who really don't know what they're talking about, and they recommend hype stocks, and when you start to do the math behind the stocks, then you start wondering like, okay, how do these guys evaluate stocks again? And the problem with, even if you know how to do your calculations and you know how to evaluate stocks and how to get a fair value for your stocks, it's very much based on assumptions. And it was so interesting to see in this video, even the analysts were saying that the stock is very undervalued. All the calculations, basically what Tom Nash did, I think were right. Obviously, we're going to be kept in high side at this point, so it's very easy for us to do this video, and everybody makes mistakes on stock pickings. However, I'm a very big Palantir investor and I'm relatively new to the investing game, and I wanted to see what is the mistake that Tom made here and can I learn from this so that we don't make the same mistake on Palantir. This is in no way bashing Tom Nash. He even might come onto this channel for an interview. Let's see if that happens. So treat this as a case study of someone who's really good but obviously made a mistake at this point, and we just want to take away the gems so we don't make the same mistake that he made.
Hey, this is Tom, and in today's video we're going to be doing a full due diligence stock review of Zoom Video Communications. As you know, in my videos I don't do any fluff, I don't sell nothing, so don't click nothing, don't smash nothing, don't do none of that stuff. Just pay attention and let's jump straight into it. Don't want to waste any of your time. So the first thing I want to know is what the hell is going on with Zoom. So as you can see right here from the past year's chart, this stock had a massive spike twice during the whole COVID pandemic. And since then, as the reopening trend kind of kicked in, this stock has been kicked to the curve, falling all the way down to 299, 289, literally the lowest we've seen it in a while. But since then, it's been doing a nice recovery pattern, reaching all the way to 400 and now pushing back to 350. So is this little pushback an opportunity to get in before the crowd? I'm going to show you why I think the answer is yes. I don't hold you hostage in my videos. I always give you away the bottom line first. I do think it's an opportunity, and I'll show you why. Before we go through the financials, let me just share with you my thesis. I think that COVID is making a comeback. It's kind of the Tina Turner of the medical world, I guess. It never goes away. Not that I'm comparing Tina Turner to a pandemic.
Basically, how he chooses the stock is super good. So the stock has almost been cut in 50%, has been doing nothing for the past year. And this is a growth company. So this is already a very good example of how to pick a good stock. And then, you do your calculation, you make your thesis, and that's the one that he's presenting to us, and then you see if it's a good stock. Obviously his thesis didn't work out.
God forbid, I love Tina, but I mean, what's love got to do with it? I'm just kidding. In any case, we basically have here a stock that's kind of become a sleeper. So in a weird way, we have this stock that used to be in its glory days kind of the flagship of the whole pandemic stocks, fell off, and now I think it became a sleeper. One of those old cars that you put a 5-liter engine in and they beat supercars. I think that may be the one. Now, here's the whole story here. As this whole resurgence of COVID and the variants and all of this is starting to slowly creep back into our lives, I think people are not pricing enough how bad things are about to get. I think we're about to go back to way worse than people imagine. Now, I'm not saying it's going to be full lockup mode again. Maybe it is, maybe it isn't. But things ain't just reopening back to normal, whatever normal is, anytime soon. And I think Zoom will be one of the beneficiaries of this kind of reversal trend. And if you look at tip ranks, you'll see that most of these analysts agree with me. Out of those 21 ratings, I think 19 of them or 18 of them see an upside for the stock. By the way, if you want to sign up for tip ranks premium, there's a 10% discount code in the description. I've been using it way before. I had an affiliate link, so you might take my word for this. So
super interesting. Again, a case study, how you see the stock price when he was recording it is 355, and basically according to the analyst, there's no downside to this stock. So the most pessimistic analyst is 345, and the most optimistic is 495. This is a 12-month price target, and this is just a lesson how wrong the analyst can be. Very interesting to see.
421.75, and if you look at the breakdown, I broke it down based on top 5-star analysts only. This is, by the way, Alex, our favorite analyst from the Palantir calls. He's a huge Palantir fan, and he has it at 430, 21% upside. If you scroll all the way from these kind of top line analysts, you'll see that they have every single one of them, apart from two, have upsides. Even this one has only 3% downside. This one has a 30% downside. But as you can see, the mass of them definitely see a huge upside, and I agree. And all you got to do is just click on this profile. Look, Alex is ranked number 2 in the country out of 7,623 analysts. And he has been covering Zoom for a while, giving it a 21.04% upside with $430 target price. So this dude definitely knows what he's talking about. 81% success rate, 37.6 average return. He's definitely a smart guy, and I'll show you why I agree with him based on my DCF and these financials. And as you can see right here, we have below 5% short interest for this stock.
Here is a big mistake, I think. I am, as you know, maybe you don't know, but I have a real estate company, and we're real estate developers, and we have hundreds of apartments that were built in South Sweden. And every time we go into a real estate project, we have one rule, is that the margins have to be really, really high, because the margins is your insurance on if things go wrong. We haven't had a project where there was no surprises. I think that the fact that we had this thinking of having to have high margins saved us from bankruptcy many times. And to do an investment because there is a 21% upside, that is just a too low risk reward ratio, because the investment can go horribly wrong, and then you might lose 50%. You're just not compensated with the risk that you take. This was a mistake for me that was made here in the judgment, because basically when you have a high margin, it secures you from being wrong. And even if, let's say in Palantir, we think that the stock is going to go to $150 and you're buying it. Let's say that you were wrong in the growth projections, you were wrong on how fast they would execute, you were wrong on many things, and the stock just goes to $80, you still made a killing, right? And this is how you have to think, I believe, as a stock investor. And you will make a lot of mistakes if you think, oh, this thing has a 3 months 10% upside, okay, let's buy it. Because if you make mistakes, you will end up losing a lot of money, and not just 10% or 20%, as we have seen in the current market.
At $355, meaning institutional short sellers are not seeing $355 as an attractive price to short. Essentially, they don't think that is expensive. And I want you to look at their gross profit margin and their EBITDA margin. 70% gross profit, 30% EBITDA margin. Look at this, 26.61 net income margin. This company is printing money. And look at the guidance here for the future growth. Look, they grew 300% this year, expected to still grow 100% next year. EBITDA growth was over 1.7 thousand, but still expected to grow by 155. That looks small compared to the previous year's numbers, but trust me, these numbers are impressive. But I think with the pandemic resurgence, these numbers are going to definitely be way higher, and I think the market isn't pricing this correctly. The problem is that people are focusing on these multiples, and they're definitely way more expensive than anybody wants to touch. However, the problem with these multiples is that they're based on anticipated earnings for next year that are way lower than they're actually going to be with the pandemic resurgence, and that creates a distortion. And if you look right here, this is the beginning of the trend. Right now, we had a massive boom, then we have the decline, and now with these 22% over the last 3 months, that's the beginning of the upward trend, in my opinion. And everything I say here is just my opinion, meaning it might be wrong, might be inaccurate, might be the rhymes of the madman. You have to do your own research yourself. I'm not a financial advisor, just a guy on the internet, so do your own research. But just looking at their earnings, look, they've beat the last 4 of their earnings, and they're going to keep doing it because the pandemic isn't really going anywhere. Look at their balance sheet, 4.7 billion in cash and cash equivalents. Look at this, 6 billion in assets, over 1.7 liabilities. This company is killing it with so much cash. And just look at the income statement right here. This is going to settle it for good. This company was growing like crazy way before the pandemic. Look, 122 million, then 145, then 166. These are quarterlies. You want to see annuals? Look at the annual growth for Zoom for the past few years. This is not pandemic related. 60 to 150 to 330 to 620. This all happened way before the pandemic. So to say that this company wasn't growing is a gross mistake. And to cap it off right here, we have our DCF. I ran this DCF basically based on a declining revenue model. Essentially, we have 100%, well, I did 90% growth next year as anticipated, then 70%, then 60%, then 50% for the next 2 years, 4% perpetual growth, 18 multiplier, which is a conservative approach. I think this company should be priced at 25, but let's just use 18 for caution's sake. And this is what we have here. 383 for the perpetual approach, 496 for the multiple approach. So we have $440, the target price for me, 355 current price.
So here's the very funny thing, guys. He did a fantastic calculation, and where he went wrong is the growth rate. And this just shows you how important growth is. So he was calculating with that in 2022, Zoom would be growing by 100%. And, you know, then scaling down, I think he said like 70 and then 60, 50 and yeah, percent growth. He is really, really pessimistic on the P that he is counting with. But this is where it went wrong. Zoom is growing 10% this year. And this is, yeah, just shows you Tesla without the growth would be a 63% stock. I calculated it. This is, you know, the big debate also about Palantir is what is their growth rate. And, you know, this is why the stock feels expensive, but if they can keep the growth rate, it was the bargain of the century. I'm talking about Palantir. So there is zero mistakes here in his calculation. And it's so interesting that this is why you need to continuously revise your, you know, model. Because at the time, I can completely understand how you can come to these numbers because, you know, they were growing so fast in the past. And technically, them growing 100% is a huge slowdown for them. So he was already being pessimistic, but obviously not pessimistic enough. And again, the only big mistake that I see here is that he's saying that your upside is 24% for a company that is growing 100% and, you know, 80% and then 90%. So basically, you're pricing in perfection, which is fine, but only for 20%. And I believe that why this was not a good stock recommendation is just that it didn't have a margin. Had he have a margin of, you know, 3x, 4x in the next, you know, 5, 6, 7 years, then the price of Zoom would have been, I don't know, $80, and then it would be up today. So this just shows you how, you know, the analyst can be wrong. I really respect Tom. He can be wrong. And why you need to do your own research, and you really need to think with risk reward. And you need to have a high margins because the high margins insure, they are like an insurance for your mistakes. So keep that in mind. Let me know if you own any Palantir or Zoom stocks. I would be interested to know. And I will see you in the next video. Bye bye.